Where are these markets going after last week's explosive rally in equities? Apparently not very far at all. So what gives now? Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. We're back. We had a little bit of a hiatus last week as I was on vacation in the great state of Florida, but we are back in the saddle. And what we're going to do here is take a look at some of the key events that stand to shape these financial markets here in the week ahead at a time when it seems like we've hit a bit of a wall. So what we're going to do here is first and foremost, unpack what is the clues that we can see in last week's performance, and then try to consider why does it seem like financial markets are getting stuck in the wake of what was generally a pretty good week for equities, if a mixed week elsewhere. So let's begin here with a conversation about, first and foremost, how markets performed and what things looked like across assets. And then what we'll do is look at the key macro event risk now in front of us to see what this might mean for next steps. Here's how the markets did last week. This is performance across some of the sort of key benchmarks. And of course, not surprisingly, we see explosive gains in equities. Surely that's not news to anyone at this point. S&P 500 up 1.6%, NASDAQ up 1.4 almost. And overwhelmingly, the bulk of these moves comes with another round of banner earnings and very optimistic guidance from Nvidia. Needless to say, the sort of focus in financial markets has been around tech, within tech, around the revolutionary powers of the emerging AI industry, and within that, Nvidia, which at this point has something of a corner on the market for the high-powered and advanced processing that needs to be deployed to get that AI revolution up to scale, off the ground, and really delivering on all of the heady narratives that have been constructed around it. The earnings report, in fact, suggested that Nvidia, which is sort of known before this AI story for advanced, high-powered microchips for gaming and multimedia use, that part of the business has basically shrunk to something like 10 or 12%. And that the data center side of things, the part where people are building out capacity to do AI at scale, that's at this point 80, 85% of the business. So clearly there is a tremendous story here. That story is likely to continue for a long time. And when we get that kind of a report last week, it becomes a kind of singular catalyst for gains, and so stocks roar higher. What's interesting within this story is that outside of equities, the narrative is not nearly as consistent nor nearly as encouraging. Taking a look at rates, we have a push higher in the front end of the yield curve. So the 2-year rate comes up, but we give it away. We're borrowing almost against it with a decline at the long end. So there's a pullback there. Rates lower at the long end of the curve. And so there is a bit of a shift in the yield curve here with a sort of flattening. And so you get the sense, as it were, that the kind of positive momentum that you might have expected in the Nvidia and the stocks story, where essentially we're building the new industrial revolution. We're in the midst of a transformative tech era here. That is not really the message that we're getting in bond markets. If it were, we would be seeing yields rising structurally across the entire curve, because we would be looking at a broad acceleration of the overall economy and therefore a need to fight inflation at a larger scale and thereby higher rates in general. There would be a level change higher, but that's not what we saw. Instead, we saw more of the story that we've seen since the beginning of the year. U.S. economic data surprising relative to expectations and giving us a sense that the Fed is going to need to do fewer rate cuts than the markets were anticipating. In fact, we've crossed into a sort of critical area here where when the Fed was forecasting its expectations for where the Fed funds rate is going this year, most recently in December, officials landed on about 80 basis points in rate cuts for this year. That's essentially 75 basis points in easing with a slight possibility for more. The Fed tends to move in 25 basis point increments, and so 80 basis points lines up with 3 cuts. Now, if we look at what the markets are pricing in, we're at a point where for the first time in a long time here, at least one would say 4 months or so, we're looking at a situation where the market is actually more hawkish than the Fed's forecasts. That has not been the story for most of this year, and indeed for most of the latest stock rally going back to end of October, early November. Stocks were roaring higher, started roaring higher then, having bottomed in late October, incidentally at a policy setting that is essentially equivalent to where we are now. Where stocks hit their bottom and started to go up in October, the market was looking for about 60 basis points in Fed rate hikes for 2024, and we're currently at 68, having been out as much as 158 at the start of this year. So as U.S. economic data has been better than expected, so too we've seen rate cuts fall away. And now they've fallen away to a point where the market, really for the first time since late November, give or take, is actually more restrictive in its expectations than the Fed. And so we are in a space here where if in fact there was a broadly positive narrative, if there was a sense that the breakthroughs that we're seeing in tech are going to spill out into a broader upswell in the overall economy, yields would be going up in tandem. They're pointedly not. The rest of the story continues to send interesting contrasting signals. Crude oil down 2%. That's not a huge move outside of the range that it's occupied, really for the better part of, let's call it, this year so far. At the very least, since about the middle of this month, oil has been essentially stuck in a narrow range. But even looking out to a weekly perspective, it's been essentially stuck between around $80 and $67 a barrel. Last week's downswing certainly still within that range. But nevertheless, here is a cyclical indicator. Here is energy. Surely, if the AI revolution is indeed upon us, you do need energy to power it, and crude oil comes off. Gold goes higher. Another strange bit, if we were to have seen a broad uptake in yields and a broad wave of positive economic momentum. And the euro is a touch higher. Now, this is a bit mixed because the euro was a little bit better off than some other currencies against the US dollar, but the general setting for the dollar here is one of stasis. It ultimately doesn't go anywhere in any kind of size last week. And so equities really do seem to stand alone. And so naturally, the question then becomes, well, are equities just offsides here? Are they in a place where speculative narrative is not being underpinned by considerations about the fundamentals of the global economy? And is that the message that we're getting in the price action that we're seeing in bonds, in cyclical commodities like crude, in yields reflective and policy reflective commodities like gold, and of course the dollar? That the dollar is standing still here as equities soar should be a point of concern for equity bulls. Because generally speaking, if there is a broad positive narrative about the great and prosperous AI-powered future that is broad-based and not just the product of speculative narrative making, then the dollar should be falling or indeed rising. But what it shouldn't be doing is standing still. If this is a pure risk-on move and money is coming out of cash and into equities, one could make the argument that the dollar is lower. And that's, of course, what we saw through most of the rally going into the beginning of this year. We saw a situation where falling yields, building rate cut expectations gave us an upswell in sentiment, and the dollar fell. Since the beginning of the year, we've seen U.S. economic data outperform, as we've just mentioned. And what we saw instead was the dollar and stocks rising together and yields going up, bonds falling, higher yields, higher stocks, overall economic optimism. The dollar rose. Not quite as buoyantly as did, let's say, NASDAQ or the S&P 500, but rose in tandem. What we see here is something entirely other. The dollar is standing still for the most part. 0.4% change on the week is next to nothing in the benchmark Euro USD exchange rate. And so you get to a place here where you say, well, if equities are telling us that there is a broadly positive story, if we instead have a positive story because of a Fed consideration and because there's going to be rate cuts this year, the dollar should be either up or down, not anchored. And of course, when we mix all of that with some of the mixed cues we see elsewhere, the sustainability of this equity rally naturally comes into question. Now, from here, we find a slew of macro data up on the calendar this week to continue shaping the narrative and perhaps start to explain what the markets are sniffing out here. The first bit comes from Japanese CPI data, and here we're expected to come down to 1.9% year on year, giving us the first reading since March 2022 below the Bank of Japan's 2% target. As we've discussed in detail on Macro Money here before, food inflation continues to be the biggest contributor by far, meaning the Bank of Japan is unlikely to get the kind of sustainable domestic inflation that it needs to really think about changing from its ultra-dovish policy tilt in earnest. Instead, this is more a function of imported food costs and a global upswing in those costs, coupled with a weaker yen over recent years, because, of course, most central banks hiked rates and Japan did not. So if we get more confirmation that the Bank of Japan isn't likely to make a big move here anytime soon because disinflation continues and because domestically inflation is all but non-existent. Really, this is just a process of watching imported inflation pressure dissipate over time, and the yen holds up against that backstory. The case for a round of risk aversion to unravel some of last week's equity gains is going to look stronger because historically the yen has moved inversely of yields. And if it manages to hold up, a risk-off powered yen move, coupled with a rise in bonds, coupled with a decline in stocks, coupled with lower yields, coupled with a stronger dollar, is going to look more like a narrative taking shape. Next is probably the most important bit of U.S. economic data on the week. There's a range of assorted releases, but this is where the focus is most acute. The U.S. personal consumption expenditure measure of inflation, this is the Fed's favored gauge of price growth. Disinflation expected to continue here, 2.4 on the headline, 2.8 on the core. Of course, we recall that mere weeks ago, the CPI measure came out hotter than expected within that context of U.S. economic data performing better than expected since the beginning of the year, giving the markets a spook and pushing those rate cut expectations down. As it happens, U.S. economic data has continued to move in the direction of outperformance, looking at data on this from Citigroup that measures data outcomes relative to expectations. And so the risk here is that we again get something slightly warmer. That then gets us another move down, another step lower in Fed rate cut odds, and gives us perhaps not the current setting of about 68 basis points in easing, but perhaps something more like 60 or even into the 50s. And if that's the case, the market starts seeing, well, we don't get confirmation from the growth side of things, as we just saw in the performance of crude oil, as we could see in the performance of copper, as we could see in the performance of some of these other measures of expectation for the global business cycle. And at the same time, we might get still tighter U.S. policy because inflation is being slow to move down to where the Fed would feel comfortable with having achieved its 2% inflation goal, or at least to be firmly on the path. And in fact, with that better than expected U.S. economic data, we have seen better expectations for inflation as well. The measures of inflation expectations baked into markets, be they break-even rates or inflation swaps, have all moved up in recent weeks, as if to say the markets now think the Fed is indeed justified in doing less. So this represents another potent surprise here, if against a backdrop of economic growth that isn't perhaps lining up with the buoyancy we see in stocks, there is also on top of it a concern about now a more restrictive Fed. Equities start to look that much more vulnerable. We get yet another piece in the global recession puzzle from China. Here, we're going to get the latest set of official Purchasing Manager Index numbers from CFLP and NBS. NBS, of course, the National Bureau of Statistics, CFLP, the official organ for purchasing and logistics within the Chinese government. What we're going to get here is a slowdown expected on the service side down to 50.5. This is, of course, in the usual logic of PMI numbers. So above 50 is growth, below 50 is contraction. When you go further above 50, that's faster growth. When you go further below 50, that's faster contraction. In the case of manufacturing, that's exactly what we're expecting to see. Deeper below 50, 49.1. So faster contraction there. On the services side, lower above 50. And so near standstill persisting on services. Now, it seems unlikely that the world's second largest economy being now at standstill for nearly a year leaves everybody else truly unscathed. And China, a key node for the global supply chain, can truly decouple. And so if ever there was a time to be both concerned about a tighter Fed and a slowing or anemic global growth story, these two pieces of data back to back, the PCE and the Chinese PMI numbers, represent such a signal. And finally, Eurozone inflation data on the menu expected to give us inflation down to 2.5%, almost back to the swing bottom at 2.4% 3 months ago. So the third consecutive month of weakening here expected. And again, food, the biggest component. Behind it, discretionary items like hospitality, recreation, and culture. And so seemingly all of the ingredients for the ECB to say, we don't have agency over food, the recessionary or near recessionary economy will probably take care of the discretionary spending, we're a hair off our target, it's time to start thinking about cuts. In fact, there are many more of them expected for the ECB now, about 30 basis points more than there are for the Fed. So if the Fed is expected to do 68 at this stage, the ECB is seen doing closer to 90. And so with that in mind, the euro might lose some of its recent buoyancy and start to come under pressure. And that is macro money for today. We will, of course, unpack all of these things in more detail as the week goes on. We're here back to normal schedule, Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what is likely to follow. I'm back on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. See you tomorrow.